It can be tempting to ignore caution when things are going well. This is especially true when the economy is robust. The bull market, which lasted 11 years and ended in March, saw modest stock price increases, easy access to finance for businesses, and many jobs with stable pay. Many investors made risky financial decisions for themselves because they believed they could always expect positive returns. You only find out who is swimming nude when the tide goes out, Warren Buffett once quipped. A strong investment strategy includes tried and true concepts, many of which have become overused over time. These investment facts aim to keep investors out of trouble by ensuring that they are on track to reach their financial goals and preventing financial errors when times are good. This is an excellent moment to examine these ideas because so many investors are looking for guidance during these challenging times. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Cash is king. Any good financial plan should begin with having 3 to 6 months worth of spending in cash on hand. The rich may be in the best position as economists and market analysts debate the possible repercussions of this global coronavirus pandemic on the economy. Their financial savings should enable them to weather these trying times if they lose their employment or face a severe fall in income. Investors who are concerned about their future income are urged to keep adding money to their emergency fund and setting money aside in case the recovery of the economy takes longer than anticipated. Number 2. Debt is bad. Numerous counselors will mention that borrowing money has both advantages and disadvantages. They are accurate. Leverage may be highly useful in the right situations. However, those who owe no money to anyone tend to be in the best financial shape. If they don't keep an eye on their debt loads, even the most seasoned businesses and investors face the risk of getting into problems. There won't be a shortage of news reports over the next months about businesses that failed due to an unmanageable quantity of debt. One of the most powerful financial situations a person may be in is debt elimination. Number 3. A clear understanding of your time horizon is key. How much risk an investor may prudently manage within their portfolio depends on their time horizon. It also helps put the challenging market conditions into perspective. If you're a long-term investor, you shouldn't be concerned about the present bear market. It should actually give you energy. It offers you a fantastic chance to purchase shares at a significant discount from its most recent trading price. If you are a short-term investor who made wise preparations, the current bear market shouldn't worry you either. Either your portfolio should have been entirely cash-based, or all of your assets should have been invested in high-quality bonds. You shouldn't be affected by the current economic climate at all because the value of your investments is not declining sharply. Investing is not a good idea if you are unsure of when you will need the money. Number 4. Dollar cost averaging keeps emotions in check. The method of consistently adding money to investments at predetermined periods is known as dollar cost averaging. Everyone goes through intense emotions. Some people can become angry over politics, but others may become angry over other occupations or a company's business practices. Making excellent investment judgments requires the absence of emotion. Making frequent, automatic investments into your investing accounts has the advantage of removing emotion from the decision-making process. As you continue to accumulate wealth, you become less interested in trying to time the market. Number 5. Boring over exciting could be the right approach. Many investors won't even consider high-quality fixed income during bull markets. After all, there is no need to invest in anything other than increasing technology equities. The truth is that bonds should be a part of every investor's portfolio. They offer the psychological advantage of reducing volatility in choppy markets. They serve as a safety net, enabling investors to withdraw money from assets without experiencing a substantial value loss as a result of a market decline. Finally, rebalancing chances arise when the value of the highest-rated bonds increases and the value of equities declines. Ignoring bonds as a key component of one's financial strategy is unwise. Number 6. Diversification is the only free lunch in investing. Investors frequently identify the trendy investment of the moment and make substantial investments in it. This is great when everything is going well, but all businesses, sectors, industries, and nations experience cycles. Being highly specialized in one area of the business could be disastrous when things go wrong. The most recent examples of this were technology stocks in the late 1990s, banking stocks during the Great Recession, and emerging market equities over the previous 10 years. History has demonstrated this. The greatest strategy to prevent your portfolio from becoming overly specialized in one market area is to diversify among a number of asset types. While employing such a technique can result in some underperformers, it might also guarantee that your portfolio will contain several investments with very strong returns. This methodical approach is a smart strategy for avoiding oncoming market bubbles. Number 7. Market return to the mean over time. Regardless of whether they experience extreme optimism or pessimism, markets eventually return to more normal, long-term valuation levels. According to this theory, reversion frequently returns the market to its previous condition, bringing returns and prices back to their initial values. The straightforward investment lesson is as follows: make a plan and execute it. Use your best judgment while attempting to strike a balance between the significance of everything else that is going on in your immediate environment. Refrain from letting the market's constant agitation and turmoil overwhelm you. Number 8. Once you win the game, stop playing. The stock market may become addicting, especially if you've collected a sizable chunk of money throughout your trading career. It's essential to understand that investing's main goal is to help a person reach their financial objectives. There is no need to continue putting that money at risk after the investor achieves that magical amount. Of course, the money should be prudently invested if there are long-term goals that will take several generations to accomplish. Any money that has already been saved to support their lifestyle, however, may be moved out of stocks by an investor. Investors who have arrived at that stage are in the fortunate position of no longer being anxious about the impending bear market. A large market downturn does, however, have one benefit: it makes investors think back on their choices from the bull market. They are compelled to reflect and ask whether they have adhered to these time-tested investing best practices. If they've deviated from the plan, it might be disastrous and financially ruinous. However, they should stand a better chance of long-term success if they adhere to the principles. Number 9. Conservative bonds. Many investors won't even consider high-quality fixed income during bull markets. After all, there is no need to invest in anything other than increasing technology equities. The truth is that bonds should be a part of every investor's portfolio. They offer the psychological advantage of reducing volatility in choppy markets. They serve as a safety net, enabling investors to withdraw money from assets without experiencing a substantial value loss as a result of a market decline. Finally, rebalancing chances arise when the value of the highest-rated bonds increases and the value of equities declines. Ignoring bonds as a key component of one's financial strategy is unwise. Number 10. High returns mean a high level of risk. Investors frequently look for the magic bullet that will guarantee superior returns with zero risk. Some people may even believe they have the answer when times are good and things are going well because their assets keep growing. They soon learn, though, that when the economy shifts, huge predicted rewards could also be accompanied by higher risk. Leverage, illiquidity, and bad credit are only a few of the risk's various manifestations. The bottom line is that you must be willing to take on a lot of risk if you want to have a chance of making substantial returns. Investors should approach every opportunity with objectivity. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.